Welcome to The Explainer. Today we're unpacking a truly fascinating story that's been absolutely dominating the financial chatter lately. We're looking at a UK-based semiconductor company called IQE plc. Now, if you follow the semi space, you've almost certainly heard the massive buzz around this name. It's been a wildly volatile ride in 2026, and today we're going to look past those flashy headlines, break down the actual source data, and figure out exactly what is going on beneath the surface of this explosive stock. Because right now, there's this absolute cognitive dissonance going on with it. Just imagine this. A company officially upgrades its revenue growth guidance to over 30%, right? That's a massive, incredibly positive signal for any business. But on the exact day they make this announcement, the stock actually drops 5%. Wait, what? How does a stock that's up nearly 1,000% this year drop on incredibly good news? I mean, is the market just crazy? Or is there something fundamentally broken hiding in plain sight? Let's unpack the puzzle. To really grasp the hype here, we have to look at the sheer scale of what's happened. A 900% rally year to date. IQE stock rocketed from roughly 5 pence all the way up to around 50 pence. I mean, when you see a trajectory like that, it's practically gravity for retail investors. It creates this massive fear of missing out, FOMO. You see the chart shooting straight up, you hear the whispers of artificial intelligence, and it becomes incredibly tempting to just jump in. But as we'll see, the higher the climb, the harder it is for the actual business fundamentals to keep up with that stock price. Section 1. The bull case for IQE. The perfect illusion. And they really do have a genuinely compelling story. Back on July 21st, 2026, IQE raised its full-year revenue growth forecast from over 20% to over 30%. The big driver here? Indium phosphide. It's a critical material used for optical photonics in AI data centers, and demand for it is just skyrocketing right now. On top of that, their aerospace and defense markets are firing on all cylinders, backed by accelerating U.S. military funding. Add in the fact that the company is completely bank debt-free with £41.6 million in cash. And yeah, you can totally see why analysts have a consensus buy rating on the stock, with Deutsche Bank even reinstating their own buy rating recently. So the crucial point is that, on paper anyway, with those incredible tailwinds driving demand in both AI and defense, this looks like a textbook turnaround story. They seem to be in exactly the right place, at exactly the right time, with exactly the right materials. If you just glance at the surface-level metrics, it's easy to see why investors have been so aggressive. But, our job here isn't just to skim the surface. It's to dig into the actual foundation. And that's exactly where the illusion starts to crack. Section 2. Burning cash, destroying value. Red flags 1 and 2. All right, let's get into our very first red flag, which is valuation. On the one hand, you've got the current trading price hovering right around 50 pence. But on the flip side, the independent financial analytics platform Guru Focus calculates IQE's intrinsic fair value at just 10 pence. Let that sink in. That means at 50 pence, investors are paying a 370% premium over what the fundamental data suggests the company's actually worth. You're essentially paying 4 times more for the stock than the underlying business fundamentals can justify. And actually, it gets even more concerning when you look at the broader industry context. Guru Focus gives IQE a GF score, which is a comprehensive measure of financial health, of just 34 to 43 out of 100. Let's put that in perspective. Out of over 1,000 semiconductor companies they analyzed, IQE ranks worse than 99.81% of them on key health metrics. The platform flags 7 to 8 severe warning signs. So we're not just talking about a stock that's a little bit expensive. According to independent analytics, it's significantly overvalued and sitting at the very bottom tier of its industry for financial health. So why is that financial health score so terribly low? Well, it mostly comes down to 2 really vital metrics: WACC and ROIC. WACC is the weighted average cost of capital, basically how much it costs a company to raise money, and ROIC is return on invested capital, which is how much profit they actually generate from that money once they put it to work in the business. For a company to actually generate value, the return needs to be higher than the cost. It's just a simple, fundamental rule of business. But looking at their data reveals a pretty devastating reality check. This is our second major red flag. IQE's cost of capital is a massive 20.15%, which, by the way, is 177% above its 10-year median. But the return on that capital? It's negative 12.5%. Think about that. It costs them 20% just to get the money, and then they lose 12.5% when they spend it. This fundamentally means they are literally destroying shareholder value every single time they invest capital into the business. And that structural issue bleeds directly into their bottom line. Despite all the AI hype and despite that massive 900% stock rally, IQE is still expected to post a net loss of roughly £23 million in 2026. If we look back at 2025, revenue actually fell 18%, and their adjusted EBITDA, which is basically their core operating profit, dropped a staggering 60% to just £3.2 million. That represents a razor-thin margin of about 3%. The takeaway here is pretty stark. This company is burning cash. They are definitely not printing it. Section 3. Supply Chains and Geopolitics. Red Flags 3 and 4. We also absolutely have to talk about geopolitical supply chain risks. Remember indium phosphide, that miracle material driving the whole AI bull case? Well, IQE is heavily reliant on raw materials like indium and gallium to make it. The catch? China controls the vast majority of these materials, and Beijing recently tightened export controls on them. This creates shortages, which naturally drives raw material costs significantly higher for IQE. Plus, their tariff resilience score is just a 5 out of 10, meaning they're highly exposed to international trade tensions and have a very limited ability to absorb these cost shocks. And honestly, we don't even have to guess how this is impacting the business, because the CEO, Yuda Meyer, outright stated they are working with customers to share the pain of that pricing. That is an incredibly revealing quote. It means IQE lacks the pricing power to just pass those higher costs directly onto the consumer. Instead, they have to eat some of that pain themselves. So their profit margins are getting viciously squeezed from both sides. Input costs are going up due to China's export controls, and they just can't raise their own prices enough to cover the difference. Which brings us right back to that cognitive dissonance we started with, the classic Selva News trap. Look, from January to July 2026, the stock rallied 900%. That massive climb means that literally every possible piece of good news was already priced into the stock months in advance. So when July 21st rolled around and they officially upgraded their guidance to over 30% growth, what happened? The smart money took their massive profits and sold, while retail investors chasing the hype bought in. The result was a 5% drop on the exact day of the good news. It's just a classic market trap. Section 4. The Hidden Red Flags Quickfire Takedown. Let's punch right through these last few sequentially. Step 1. They have no economic moat. Guru Focus scores them a 3 out of 10, meaning there's no durable competitive advantage. Their tech can be replicated by competitors. Step 2. Massive customer concentration. A huge chunk of their revenue relies on just 1 or 2 big clients. If even one leaves, it's disastrous. Step 3. Zero dividend history. You're relying entirely on capital gains in a stock that's already 370% overvalued. And step 4. Their wireless segment actually collapsed 40% in 2025 due to weak smartphone demand. If that segment doesn't bounce back, the entire valuation rests solely on the shoulders of the AI narrative. Section 5. The Final Verdict. Weighing the Evidence. So, what's the core takeaway of this explainer? Look, on the one hand, we absolutely have to acknowledge that IQE is in a demonstrably better operational position than they were last year, right? They have zero debt, over $40 million in cash, and the demand from AI and defense is very real. The turnaround has genuine merit. But on the other hand, you have the price. At 50 pence, you are paying a massive premium for a business that is currently unprofitable, destroying capital value, facing severe geopolitical margin pressure, and lacking an economic moat. It really boils down to this. IQE might be a great company operationally, but at this current valuation, it's trading at a terrible, highly risky price. Which leaves us with this final question for you to consider as you do your own research. With everything we've looked at today, weighing the soaring guidance against the burning cash, the AI hype against the geopolitical reality, is IQE actually a buy at 50 pence? Or is this a 900% bubble just waiting to pop? Take this data, apply it to your own analysis, and never invest based on hype alone. If you found this breakdown helpful and want more structured, deep dive explainers just like this one, make sure to subscribe. Keep learning, stay focused, and we'll see you in the next explainer.